When you tap buy on a trading app, it feels like you're sending $200 straight to the company. In reality, the company receives 0 cents. Your money is headed to a stranger, someone you'll never meet who decided to sell. This invisible swap between two strangers happens in a fraction of a second, instantly updating a price that thousands watch on their own screens. If the business isn't getting our money, what are we actually buying? And why does this high-speed matching system exist at all? The answer starts a few hundred years ago. Imagine you want to send a wooden merchant ship across the ocean to trade for spices. The cost is enormous, and if a storm sinks the ship, you lose everything. No single person could afford that kind of risk, so merchants came up with a way to share the burden. Instead of one person paying for the whole voyage, dozens of people would chip in a smaller amount. If the ship returned, everyone shared the profits based on what they put in. If it sank, the loss was spread out, so nobody was financially ruined. Modern businesses work the same way. A local coffee chain might need millions of dollars to build 50 new locations. They could take out a bank loan with heavy interest, or they could find one wealthy investor, but that often means giving up too much control. Instead, they sell pieces of ownership to the public for the first time. This is the initial public offering, or IPO. In this photo, executives celebrate at the New York Stock Exchange after successfully raising cash directly from thousands of investors at once. This primary market is the only time your money actually flows into a company's bank account to help them grow. Once those shares are out in the world, the company steps aside. From that point on, investors only trade those existing shares with each other on what's called the secondary market. Think of a company's total ownership like this pizza. When you hold a slice, you don't own a physical desk at their headquarters. You own a claim on its future worth. As the company earns more and expands, the entire pie expands. Your slice doesn't get wider, but because the pie is larger, the value of your piece grows too. Because the company isn't collecting your cash anymore, the stock price you see on your screen is just a measurement of what the collective crowd believes that future slice of pizza is worth right now. The stone pillars of the New York Stock Exchange are a landmark of the past. Behind those walls today, the actual exchange is a network of highly regulated matchmaking software. This software connects very different groups of people. You have retail investors, regular people holding shares for years to build savings, and then you have day traders who rapidly buy and sell every day to try and profit off small price swings. Then you have institutional investors like pension funds. These groups manage billions of dollars. As this diagram shows, their trades are so large that when they move, the sheer weight of their orders can push the entire market price up or down. You also have market makers. Think of them like the stores of the financial world. They keep a constant inventory of shares so that if you want to buy, they always have something in stock. And if you want to sell, there is always a place to go. When you hit buy, the exchange's algorithms instantly sift through all these different players to find your perfect match in a matter of milliseconds. The mechanical result of that matchmaking is the price you see here. The bid is the highest price a buyer is willing to pay, and the ask is the lowest price a seller will accept. When those two numbers meet, a trade happens and the official price is updated. It is a constant tug-of-war. If lots of people want to buy, they start offering higher and higher bids to get a seller to agree, driving the price up. If everyone wants to sell, they have to undercut each other to attract a buyer, driving the price down. These prices aren't just a scoreboard for how a company performed yesterday, they are a prediction of what it will do tomorrow. This is why a company can announce record-breaking profits and still see its stock price drop. If the crowd was expecting even better news, the reality feels like a disappointment. It's also why a brand new tech startup can be worth billions of dollars before it even makes a profit. The price isn't counting today's cash, it's counting on the company to dominate its industry years from now. Ultimately, the stock market is a massive, decentralized voting machine. Every day, millions of strangers meet in these digital spaces to place their bets on which businesses will shape the future.